This is the Peer2Peer podcast. I am your host, Greg Stahersky. So to start things off with some good news for once, Bitcoin has been on a bit of a tear lately after a very long consolidation phase in the mid $16,000 range, going from 16.5 to a little over 23,000 within the past few weeks. It's currently topped out at around the 23,200 level where it's currently sitting as of the time of this recording. And who knows where it'll be by the time anyone listens to this. So that's almost a $7,000 appreciation in about 11 days for a solid 40% gain, which puts it up roughly 36% since the beginning of the year. Not bad for an asset that was declared DOA in early December. This, of course, left some high margin bears really feeling the pain with around $710 million worth of short positions completely liquidated over the course of the current rally, which was the most in over 3 months. Now, to add some more color and context to the annihilation, on January 13th, in a 1-hour time span between 12 and 1 a.m. UTC, about $89 million worth of short positions were liquidated across some of the largest exchanges. So not a very good start to 2023 for the bears. Now, from my own research, I haven't really seen a very good explanation for this rally, although we did get a new all-time high on the network hash rate, topping out at over 276 exahash, reminding everyone once again that the Bitcoin network is by far the most powerful network on the planet, and there is no second best. Unfortunately, overall sentiment hasn't followed the hash rate gains, given that there's still a lot of bad news out there that the industry needs to digest. But for now, it seems like supply and demand is taking the reins, the hash rate continues to climb, and there just isn't enough cheap Bitcoin out there for the hodlers that are looking to accumulate for the long term. All right, now this next story, I had to read this a few times just to make sure I wasn't hallucinating. But it looks like Kyle Davies and Su Zhu from the now defunct Three Arrows Capital, who got absolutely crushed in the collapse of Terra Luna and USDT to the tune of about $10 billion. Well, they're back at it again, pitching a bankruptcy claims exchange called GTX. That's right, GTX. Because of course, G comes after F. And who wouldn't want to brand their exchange after FTX, right? The exchange that was being run by amphetamine addicts and con men, which is now responsible for one of the largest destructions of wealth in modern day finance. Folks, you can't make this stuff up. Only in the magic world of crypto are you going to get two guys who are currently hiding out in non-extradition countries attempting to raise $25 million to let people buy and sell bankruptcy claims, or as they refer to it as cross-asset trading on a public market. Now, the thesis is that the crypto claims market is a $20 billion quote-unquote opportunity that should trade on a public marketplace. And apparently there's some real urgency here too, because they're looking to bring this monstrosity online by the end of February, quote-unquote, at the latest. What's even more startling here is that they've allegedly got 60 devs at the ready to help them realize and construct this nightmare. And there was even one slide in this pitch deck quoting the despair of FTX users who are attempting to sell claims at 10% face value instead of waiting 10 plus years for the bankruptcy proceedings to play out and to process their disbursements. Now, let's also keep in mind the irony here. There would be investors of Kyle and Su's fund likely using this platform, attempting to recoup a fraction of the losses they incurred, entrusting their capital to these two. Folks, it should go without saying, there's no reason to trust these guys, and that they have any good intentions here, and that they're genuinely trying to help or even look out for the small retail investors who have gotten completely dusted by the multitude of bankruptcies that have occurred in the last 3 months. And just to reiterate, Kyle and Su have yet to apologize publicly for any of the damage that they caused to their last round of investors. All that they've really done is blame other people, run away from law enforcement, and pretend like nothing happened. Now, it's abundantly clear these two are still lacking any basic understanding of what trust or integrity means in the world of finance. And the worst part about this is there are VCs and investment firms and other gullible people out there who are going to put money into this mess. You should not be one of them. This sounds like a complete disaster. and you would essentially be betting on two of the biggest swindlers in this space to help you get your money back. I would avoid this platform and anything that Kyle and Sue touch like the plague. Now, I want to get out of the world of crypto for a few and talk about some of the latest rounds of layoffs that we've been seeing coming out of the tech industry, as some of the biggest blue chip big tech companies begin to prepare for a deep economic recession in the US and across the globe. Now, you have prominent industry titans like Amazon, Microsoft, Salesforce, and Meta. They've all let thousands of workers go over the last couple months, with Google being the latest to announce 12,000 layoffs in a large group of business segments, including Chrome, Search, Android, and Google Cloud. Now, an interesting side note here is that Google Brain, which is the division responsible for R&D into areas like artificial intelligence and machine learning, they seem to be largely unaffected by the job cuts, perhaps hinting at a major shift in focus for an outfit that's otherwise been heavily concentrated on search and advertising. And Microsoft has also followed suit here because they plan on investing another $10 billion into OpenAI, which is the company responsible for the incredibly popular language modeling chatbot known as ChatGPT. Collectively, about 130,000 people have been told to hit the bricks in the last 12 months. You have 10,000 at Microsoft, 18,000 at Amazon, 8,000 at Salesforce, 11,000 at Meta, and the list goes on. And while mass layoffs in any industry are typically a bad omen of things to come, it's worth noting that a lot of these companies grew at an absolutely incredible rate during the pandemic. You have a lot of people that were forced to stay home. You're spending more time watching YouTube videos, playing Xbox Live, sharing pictures and stories on Instagram and Facebook, and buying household items on Amazon that were otherwise unavailable at retail stores. Now, the question is, well, what does all this mean? I think there's two takeaways here. One is that many of these large enterprises probably expanded a little too much, too quickly during the pandemic to meet overwhelming demand. And now they're trying to right-size their workforce for what looks to be, again, an impending slowdown and contraction of the US economy. The other point to make here is that at the height of the pandemic, a lot of CEOs made big bets that their businesses were going to take these massive, multi-year leaps forward permanently. And given the current economic conditions, well, that just hasn't come to fruition. As inflation remains at multi-decade highs, and you have CPI clocking in at 6.5% in the month of December, consumer discretionary spending has begun to roll over on a year-over-year basis. A lot of demand for these tech-based products and services has overall begun to subside. Unfortunately, I don't think we've seen the last of these job cuts, and I wouldn't be surprised if we hear a similar story from Apple in the next couple months, although they've largely avoided joining in the layoff procession in the last year. Now, in the same way these companies have begun to cut costs, I think it's a great idea for everyone to do a little bit of personal inventory and expense tracking and figure out where you could possibly save some dollars over the course of 2023. Now, another story that was recently brought to my attention that I admittedly haven't seen much coverage of in the mainstream news circle are details concerning a massive government surveillance program that was executed by the Arizona Attorney General's office in collaboration with the Phoenix Field Office of the Department of Homeland Security's Homeland Security Investigations Unit. Now, according to the ACLU, these institutions were engaged in the indiscriminate collection of money transfer records for any transactions exceeding $500 sent to or from Arizona, California, New Mexico, and Texas, as well as any transfers sent to or from Mexico itself. So in short summary, anytime anyone in any of these states or Mexico used a company like Western Union, MoneyGram, Cash App, or Venmo, and the amount of the transaction exceeded $500, a record of the transaction was entered into a database controlled by the Arizona Attorney General and was eventually shared with a large collection of other law enforcement agencies. Now, the key word here is indiscriminate. It didn't matter if you were paying a bill or helping a friend or relative out with an emergency expense or sending a remittance back home. They didn't care. They wanted to know about it, and they tracked it in a database that was ultimately under the control of the Arizona AG office. Now, to add insult to injury, they submitted 140 illegal subpoenas to the aforementioned money transfer companies in order to force them to provide this information. What else I find interesting about this surveillance program, and perhaps one of the major reasons why it remained covert and obscured from the public for so long, is the striking resemblance it has to a widely unpopular $600 reporting threshold that the IRS planned on enforcing for third-party settlement organizations, also known as TPSOs, that was slated to begin in January of this year. Now, obviously, someone in upper management thought it was in the best interests of the public that they didn't know this information was being collected without their consent. Another startling revelation of this program was the overwhelming scope and scale of it. This database grew from about 75 million records from 14 TPSOs in 2017 to 145 million records from 28 different TPSOs in 2021. By May of last year, there were over 700 law enforcement agencies that had access, or still to this day have access to this database, which is anyone from a sheriff's office in Idaho to the LA and New York police departments to military police units. Now, granted, it's rare to hear about so many different law enforcement agencies actually cooperating together to gather intelligence. But in these circumstances, it always seems to result in the complete loss of privacy for the average US citizen. Now, the implications of a program this expansive and far-reaching, done in such a knowingly obscure way, without the consent or knowledge of the people actually using these services, raises some serious questions as to how far these agencies should be able to pry into the financial activity and personal lives of the public, who are ultimately responsible for funding the livelihood of these institutions in the first place. I think this is yet another case where, as a society, we have to decide, how much of our privacy are we willing to give up in the name of security? It's a question we should continue to ask, especially as we become more reliant on some of these technologies in our everyday lives. Now, to end on a positive note, I think it's worth mentioning that it only takes one good person in an authoritative position to bring a lot of darkness into the light. And as such, Senator Ron Wyden of Oregon, who originally raised some questions about this program last year, he deserves a lot of credit for coming forward with this story. And I'd have to assume he probably isn't going to be on the Christmas card list of the Arizona AG's office any longer. I think that's going to do it for episode number 2 of the Peer2Peer podcast. Just want to say thank you again to anyone and everyone for tuning in and listening. I really appreciate it. And as always, stay safe, be cautious, be smart, and don't trust, verify.